stay warm, stay safe here today. It's going to be some pretty nasty weather around the East Coast and down here in through Texas. So good day to be sitting here talking about options. So what I wanted to do today is kind of dive in and look at. I want to go over 7 different option strategies for income and revenue, and then I want to kind of focus in on my favorite, which is the calendar and counter diagonal. So these are some really dynamic strategies, and that's what I want to kind of focus on here today. So a little background on myself. I've started my trading journey back in the 80s on the oil side, and was fortunate enough to get in with a company called Coastal Corporation at that time. When I was looking around for a job, I was able to get my foot in the door there, and they actually had a training program where they would train you to trade crude oil and oil products. So I got into that program, and it's a really great experience. It opened up the whole journey of my trading experiences down the road. So I've been doing this for now over 30, 40 years. And but with that set up, they sent me down to their refinery in Corpus, and it kind of started out there for about 2 or 3 months in the refinery, just kind of learning the fundamentals and the foundation of oil. Bring it into the refinery at Corpus, and then put it to the distillation towers and producing all the different products. So it was a really good eye opener to understand that whole concept and the foundation. Eventually got into the trading desk at Coastal in the cargo side, and sent me out to Singapore for a couple of years and traded products and oil out there. And then, I went to work for a company, Transworld Oil, and at that time, back in the mid 80s, they were the largest oil trading company in the world. It was Transworld, Fibro, and Mark Rich. So spent about 17 years there, ran the international trading desk for 10 out of Bermuda, and just a really fantastic experience. We were in all the different energy markets, and then eventually got into all the other, futures markets and foreign exchange, and then started my option journey back in the mid 80s. We started selling options on crude oil and did a lot of option trading there, and kind of never looked back. So just a little flashback as far as my trading journey, where it started. And now I have Power Cycle Trading. I love to trade and teach options. So that's what we're going to talk about here today, or a number of different option income strategies in those two of my favorites, which are the calendar and counter diagonal. So again, sit back, get your notepad and pencil and coffee, stay warm, and let's get going. So the following presentation today is purely for educational purposes. Any stocks, options, or futures mentioned does not constitute advice and should not be construed as a recommendation. Now, option income selling strategies uniquely enable you to enhance returns by the way of combining long options and short options so that you can generate income on a regular basis. So, the income option strategies are typically shorter in duration, whereby option premium is going to be sold either on a weekly or monthly basis. So this can generate really significant percentage returns on your underlying security or stocks or whatever you're trading, even if it hasn't moved. So it's kind of like collecting rent on a security versus, like you collect rent on a, rental property. So it's a really great strategy to enhance your returns and add a little bit of different additional income and profits to your trading. So let's go through kind of the steps to kind of, highlight what you need to know. So step 1 is the secret of income using options. And basically that's really knowing how to sell time. So when we are trading options and option strategies designed for income, the most important option factor is understanding the concept of time and its impact on price. So we can actually trade time by selling time to take advantage of option time decay or the time value as it decays over the lifetime of the option cycle. So first, let's take a look at the price components. Okay, so first, one of the major price components for a value in an option is going to be the time value. And that's the extrinsic value of your option. And it's the premium that a trader or investor is going to be willing to pay over the current exercise value, the intrinsic value, based on the option's potential to increase in value before it expires. Now, it's this change in the value of your option based on time decay. We can then measure it using the Greek called the theta. Now, time decay is going to increase as expiration draws near, and it's going to decrease as options go more in the money or out of the money because the extrinsic value gets less. Now, option theta decay really starts to accelerate when we get the last 30 days of an option cycle. That's where it really starts to soar. So here's just a good graphic example of time decay. So here's kind of a time illustration to show you what it kind of looks like. So this would be good, like if we started out 120 to 90 days out, there's very little time decay. But as we get closer in and 30 days out to expiration at day 0, then it really starts to accelerate and fall off. And now with the weekly options and 0-day options, there's a lot of different ways that you can take advantage of collecting premium or buying really cheap options due to the deterioration of the time decay component of your option. All right, so this is really important to understand time and the impact that it has on your option. Now, the step 2 is knowing how your option pricing works, how to value the option. So when we look at an option value, it comes down to the major 3 components, basically. It's going to be time value, that time value component, times the implied volatility, times your underlying security value, which is your intrinsic value. So once we know these values, then we're going to be able to, set up what strategies to use know what the option premium should basically be based on those strategies that we're using. So let's go through here another kind of example here of how to value your option. This is a really good little table to show you. So when we look here, you're going to see time value times the implied volatility times the underlying security value will give you the value of your option or the option premium. So I'm going to keep the intrinsic value here a constant of 1, so you can just see how time and implied volatility affect the value of your option. So every Thursday we have a new weekly option, and on that first day we're going to have 100% time in that option value. So time value times the implied volatility. I just plugged in a number here of 300 for the implied volatility, so you can see how it flows through with time decay. So here we start out, with a $300 premium. Now, we go through the weekend, we come back on a Monday, and you can see that the time value component then has been cut in half. And even if we've raised the implied volatility, I plugged in a higher value here of 800, leaving the intrinsic value constant at 1, we barely push the value up at all. It's only up to $400. Now, let's say we had the implied volatility was only 200. Well, then you can see your value of your option is going to be only $100. So the really takeaway is that when you look at the end of your option expiration, day 0, when it expires, time will go to 0 and your implied volatility go to 0. And these are 2 of the major components in your price or the value of your option. So that's what we want to take advantage of, and we want to be able to take advantage of from either selling options or know how it is affecting us on the buy side of options. So that's a really key. The first steps is understanding the value of the option. Now, step 3 is trading the probabilities. So this is kind of what I call the market maker secret. It's what they don't really want you to know. And this is how they make their markets and how the professional money trades. So, when we look at option markets, they use, option markets use mathematical market probability statistics for pricing the movement of an option into its expiration. So by knowing the probability of your underlying security or stock finishing within a certain price range at expiration is really key to determining what options to buy or sell and what option strategy to use. Now, this forecast is referred to as the implied move of your stock or the implied expected move. And it's basically a theoretical estimation of a plus or minus 1 standard deviation move over your current underlying security value at expiration. So when we look at this is a really good illustration. Here's a kind of what we call a normal distribution curve to show you the distribution of data. And in this illustration, we're using price. So at the top of this, bell curve or distribution curve, we've got the price of XYZ trading at $500. Now, if you look at selling an out of the money option, one standard deviation out, you're going to basically start out with an 84% theoretical chance of that being a winning trade. And that's based on your option deltas and how that applies to the statistics of the math. All right, so when you have an option delta of 1, that's equivalent to 100 shares, or we call that an option delta of 100. So if you were to, take the outside one standard deviation point here, which is basically like a plus 16 or 20 delta, or on the put side, which is like a minus 16 or 20, you're going to have that one standard deviation move out would be $520, or down would be 480. So if you look at that move, that's basically a 4% move up or down. Now, when we look at option delta, we can use that to give us the trade probabilities based on a delta of 1 or 100. So if you were to sell that 16 delta right here, which would be this price point right here, the 520, and you take 16 delta and you take that from the 100, a delta of 1 is equivalent to 100, that gives you 84, okay, the reciprocal. So the way to look at this is then if you were to sell that 520 short strike, then theoretically there's an 84% probability that the price at expiration will be below 520. All right, so that's one way to look at it. Or if you sold that put short, the 480, there's an 84% probability that price will be above 480. All right, so that's kind of a takeaway there of how this can affect and how to look at option delta to kind of give you trade probabilities. Now, if you were to go way out the curve, you can see then if you sold like a 5 delta down here, you're going to have a 95% probability. So that's like a 2 standard deviation move right there. So you can see the further you go out on the tail, the lower the probability is that the price will reach that price point. So you increase the probability of that trade being below that price strike at expiration. All right, so that's really key. So when you're selling options, we want to know what the probability is theoretically of that option that we sell being out of the money or expiring worthless when it comes to expiration. So this is a really quick way to assess probabilities of a trade using the option delta. So if we go through this table here, this is like an example. This would be Apple, and this is a Thinkorswim platform. And so what this is showing you is that this is right here. It says probability. That's going to be probability out of the money. And then you can see this column here is delta. So if we look here at Apple trading at $190, and let's say we go to this series here, the 5 July, that's got 28 days to expiration. And we come down to the at the money strike price, which is 190. And we look over here under the delta, it shows you 0.52. So basically that's saying that there's a 50% probability that the price will be at 190 or below at that 190 strike, or 50% chance it'll be at 190 or above. All right, so that's the way you can kind of use that to give yourself, an example of probability of that price. Now, when you go way out or further out of the money, let's say we go out to this 215 strike right here, and you look over to the delta, it's showing you a delta of 5.05. So basically, what that is that showing you that the probability is only theoretically about a 5% chance that the price will be at 215 at expiration. Now you look over here to the probability out of the money column, and it shows you here 95, right? So here's that delta of 1 or 100. You minus that delta of 5 that you sold, that short strike with a delta of 5. So that's giving you a 95% probability that the price theoretically will probably be below that strike price at expiration. So you can see that how to determine probabilities. If you look at your delta and you're saying, let's say you're wanting to sell that 215 short strike on Apple, well then you can quickly assess, okay, if I sold that 215 strike, there's only about a 5% probability theoretically that it'll be at 215 at expiration, or the other way around is there's a 95% probability that it'll be below. So that's a really quick way to assess, trade probabilities. And if you were looking to buy that 215 strike, well, what do you have? You only have about a 5% chance that price will be at that 215 strike at expiration. So that is why then the option premiums are so low or so cheap. You can see here at the 215 strike, it's showing you the bid offer is 26 at 32 cents. So, basically to buy the 215 call, let's say, would only cost you $30 per spread, and that's cheap because there's such a low probability of price being at 215 at expiration. So that's a really quick way to assess probability of your trades before really having to do anything else. So that's the first step that we always take. What is the trade probability based on the implied expected move in our option delta? Now, by using probability analysis, this provides us a very useful tool then for determining price targets to trade against. And it's a free tool basically on most option platforms. So based on the math of probability, you can see that approximately about 70% of options bought are going to expire worthless. And based on this, it's always a good idea for traders or investors to consider selling options as well as just buying. So buying or adding option income selling strategies to your trading portfolio, this will make a dramatic and positive difference in your trading performance, when you use the different strategies correctly. So remember, trading is a business of probability. So to be successful, controlling your risk and incorporating high winning probability option strategies is, what's going to win the race down the long stretch. And I always tell members of my clients that when we're trading, we're looking to hit singles and doubles with options, and then occasionally we're going to hit that big triple or home run. So it's really staying consistent in the game and controlling your risk, and that's what's going to win down the road. So the first thing that I always look at is I assess what is the risk, and then I look back into, okay, if I hit a certain target, what is my return on that risk I'm putting up? So step 4 then is selecting the right income option strategy. So one major goal, in my opinion, for traders should be to select trades based on what's going to give you the most consistent positive return with low defined risk, and not always that great, home run out of the gate. So one of the ways to achieve this then is by knowing the best option income strategies that are out there and available to you, how they work, and then selecting the one that's going to be best suited for your trading style, your risk profile, your trading account, and the market environment you're trading in. So let's take a look at the different strategies that you could look at using to give you an idea of maybe which one might be most beneficial to you. So we're going to look here at these strategies today. So we're going to look at the covered call. We're going to look at a protective collar, which is also a great way for hedging your portfolio or stock or whatever you're trading. We're going to look at the vertical credit spread, how that works for income. We're going to look into the iron condor credit spread, the butterfly spread, and then two of my favorites we're going to kind of focus in on will be the income calendar and the counter diagonal. Now the counter diagonal is really an exceptional trade, very dynamic. And this is one that we use quite a bit at Power Cycle Trading. This is one of our go-to strategies that we probably use this strategy more than any of the others. So we're going to really kind of dive into these and show you, but kind of highlighting on these last two. So first, though, is your covered call. So this is a good income option strategy, and it's basically a good one for long-term growth and income, to collect. Used by investors and really starting to be used a lot by institutions for their clients. So it's the most basic income strategy, yet it's highly effective for bringing in either weekly or monthly income. So let's start out with this one and kind of go over an example. So Joe has like 500 shares of the XYZ company. that he bought for originally at $40 per share. Now he's tired of just getting that 2.5% annual dividend. So, he's heard about, covered calls and collecting income. So he wants to look at that and see how they work. So what he does is he goes out and he looks at how to use that for collecting income on his stock that he owns at $40. He's going to go look at selling calls against it. So let's go through, how it works, the steps involved. So first off, in this example, he goes out and on December the 12th, Joe sells 5 contracts of the 23 January weekly call options with a strike price of 42.5. Remember, he's long the shares at $40. Now, for selling that strike price at 42.5, he's going to get $1 for each call that he sells. All right. So now he brings in $500. So that goes straight to his brokerage account, sits there and into the account, and he is looking for that into expiration. Now, if he was to keep that whole $500 from selling that premium, that's about a 2.5% return over this 6-week time period. So he's, really excited about that, and just getting that 2.5% return from the annual dividends. But the other great thing is he's going to also get to keep the dividend income, so the return there, plus the return if he keeps the option premium. So he's got a way to really bring in some additional income on those shares that he owns at $40. So, here's what it means for Joe. So Joe has given them the right to the buyer of those call options, the right to buy that stock, the underlying stock, on Friday, January the 23rd or before at $42.50, that strike price that he sold it at. So here's what happens at expiration on Friday the 23rd. Now, if the stock went to, say, just $42, the options are going to expire without being exercised, since the value of XYZ is less than the strike price of $42.50 that he sold. So Joe got to keep, the full premium, and he made $500 from selling those call options. So he's very, very excited about that additional income stream that he's just, put into his trading and investing portfolio. But what happens if the stock goes to 43? So if it goes to 43, here's the easy thing. Joe could buy back the options. So on the day of expiration, let's say the price of that option due to time decay would be around, let's say in this example, 50 cents. So if he was to, buy back for 50 cents those options that he had sold for $1, he made 50 cents per option contract, or $50. So $1 price he sold the options at, he collects 50 cents from the time decay. Now they're only worth 50. So he just made that 50 cents or $50. So, this is still good. He was, had that additional about 1.25% return over that 6-week period, or annualized about 10.8% annually, plus the dividend income that he received from the dividends. So, he's really excited about this new stream of income. And as long as Joe owns the shares, then he can just kind of repeat this selling process for the next week or month out, repeating this kind of strategy over and over and over. So this means this main concept of collecting income or rent weekly on your long shares is a great additional income stream for your stock or portfolio or trading portfolio. So the other great thing too is that remember, it's going to amortize down over the long haul the cost of your shares. So he bought those shares at $40, but if he keeps bringing in 100 to 500 to more each and every week or month, that's also amortizing down his costs. And at some point, he'll go, amortize down those shares potentially to zero. So that's the other exciting part of it. Now, before we get too far along here, I've got a really in-depth course that I'll be doing next Saturday, actually, on my two favorites, which will be the calendar and calendar diagonal. So I just wanted to kind of put this out there in case you have to get out to cover the plants or do whatever before the ice storm hits your area. But so next Saturday on the 31st of January, I'm going to be doing a workshop which will start at 11 a.m. Eastern to 2 p.m. or thereabout, and then we'll finish up with part 2 on Monday, February the 2nd from 4 to 5 p.m. Eastern. Now, let me give you the link here. We'll go through this, kind of highlight it, and then we'll, any questions at the end, we'll, we can go into this more in detail. If you would like to join us here, let me give you the link. I've got a really nice package for you, everybody here today, and you're going to get 15% off the price. So use this link here, use powercycletrading.com, and I'll copy it and paste it in there, /special. And then when you get in here, you can copy it and paste it, or just click on it with your, you should be able to click on it and it'll pull it up. Let me see, it's not coming up. 1 second here. And then put in small cap CAL15. And okay, there it is. And then that'll give you this 50% discount. All right, so click on that, and what that is going to do is going to pull up a payment link for you, and let me pull that up and I'll show you. So we'll go through this, and then we'll move on to the next part of this workshop today. So click on that, and then first off, though, I'll go through the pricing. So the price of the course will be $197, but today, if you use that discount code of CAL15 small cap, it'll be $167. Okay, so this is 95% off on the course package, and there are 6 different bonuses that we'll go through here as well. Now, if you want option 2, this comes with the indicators that I'm going to throw in here for what we're going to use in the course, plus all the bonuses. For an additional $30, you can get this. This is option 2, so it will be $197. Okay. Now, if you also then, I've got another package, which is package 2, which is going to give you my alert service and my trading club for the next 4 months. So if you'd like this package where you get my alert trades, which I'll show you all the different ones that we've done recently, and the what we've done, a summary of the results there. But if you like this for the next 4 months, and you can start and stop this whenever you want. So there are 5 different type of alerts that I send out, and I'll kind of go over those here in a few minutes. Plus you'll get 4 months of my trading club, plus 4 months of my alert service, and the live recorded course and all the extras. So this will be $597, but today with the discount code, it'll be $507. And then if you want this with the everything in option 2, which gives you the indicators, which I'll show you, all the bonuses, for an extra $30, this will be $537. So there is a 2-pay as well for the package 2 that you can use if you'd like. So this is kind of a summary there. And then if you pull that link up, click on that, this is what you'll see. And let me get rid of all of that. So this will pop up. And then if you scroll down, you'll see here, use CAL15 small cap, and here's your course package 1, option 1. So this is going to be best used if you already have my indicators, and I'll go through the bonus package and stuff there in a little bit. But this gives you access to the 4+ hour course on the counter diagonals, $1,600 value. So for today, 167, use that code. And what you're going to get with this is you'll get the live and recorded course. You'll also get a 30-day trial membership to my trading club, which gives you access to my trading room, Q&As, my daily market videos and discounts on courses and things. And then the other bonus you'll get is follow-up Q&A plus my option trading tutorial. So click on here, buy now, and come down here, you'll see this pop up, your payment link, and I'll show you everything that you'll get with this option 1. Everything listed here. Come down here to promo code where it says that, and put in small cap CAL CAL15. Click on that, hit apply, and you'll get the course and those extras for $167 today. Now, if you do want my trading indicators, my 5 study set indicators, available for Thinkorswim, TradeStation, EasyTrader, TradingView, you can add that to your payment right there. It's $195 to your card if you'd like those. And then if you want to have option 2, which gives you my additional bonuses and my 2 indicators we're going to use in the course, then this will be $197. So basically just the 167 plus 30. So it's 93% off. But with this package, you'll get my cycle reversal indicator, which is $197. These are all my prices on the website. You're also going to get my extreme range band indicator, which is $197. You'll get my Fibonacci price target mapping course. This is what I use for all my target mapping for price targets up or down, for for defense strategy stop areas that I use. So this is $297 on my website. You'll get 30-day trial membership to my trading club, $97, and if you continue on, renew that as $97. We have other price points as well, plus the follow-up Q&A, option trading tutorial, and all that, combined comes out to over $2,800 there. So that's just for additional $30 there. You get all that great stuff. And again, just come down here, you'll see everything you've got listed here, so you know what you're buying, and put in Cal 15, excuse me, and click apply. And that should have dropped down to 197, but let's see here. Well, it's not working, so good deal for everybody here. So today, if you do want, let me back up here. This is not working, so what you're going to get, what I'm going to give you then, is everybody here, if you want to, purchase and join me next Saturday, instead of, option 1 being 167, since that link's not working, I'll give everybody here the option 2, which gives you all the indicators, the bonuses, etc. 197, but I'll give everybody here today, we'll get it for 167. So, if you buy, anybody buys here today, use that buy link there, put your Cal 15 in there, and you'll get everything here today for 167. So basically, again, just kind of review there. This will be course package 1, option 2. Instead of 197, it'll be today 167 due to that faux pas. And then on course package 2, this is where you get my elite open to close alert service. So this is basically where you'll get all my 5 different alerts that I send out for the next 4 months, plus 4 months to my trading club, and then everything in course package 1, which would be under option 1 or 2. So you can get all that stuff today for 15% off. And let's go through, I'll just here's a summary of the alerts so far. So since starting the alerts back, my first alerts back in May of 2018, down here you can see, we've had through the 22nd, we've had 972 trades closed out, 690 winners, 74 break even, 208 losers, running a win break even rate of 79%. And so these are, unaudited results, just kind of full, clarity there. And then, breaking this down, showing you what it's done recently. So since January 1st, 2025 through January 2022, this year, 26, we've had 140 trades that we've closed out, 92 winners, 19 break even, 29 losers, a break even win rate of 79% there. So really high winning probability trades that I send out. And there are 5 different types of alert trades that I do send out. And here are the trade results for the counter diagonal alerts that I send out. So we do a lot of these, and we've had 396 trades closed out, 279 winners, 29 break even, 88 losers, and a win break-even rate of 78% unaudited right there. So that's a review there. So if you want course package, the alert service package 2, and if you come down here, I have 5 different type of alerts that I send out, depending on what the market's given us. So these are either, going to be butterflies or long condors, counter diagonals, what we call monthly penny trades, which are typically butterflies, selective earnings trades, and credit spreads and debit spreads. So those are the 5 different ones that I'll send out. When I do send out the alert, you'll get a trade guide for each, how they work, set up video review of the trades. They're archived, so you can go back and review them. And then you'll get my live weekly Q&A, live and recorded every week for the next 4 months. My newsletter, video newsletter every day after the close for the next 4 months, and access to the virtual trading room during the week for the next 4 months, and 50% discounts on anything on my website, courses, and trading software. So a really great deal there. And so if you do want my alerts, just come down here, and I've got 2 different ones. So you can see here, course package 2, option 1 would be $597. Today it's $507. And just come over here and click here, and you'll see that you get it's $597. You put in that promo code CAL15 and hit apply, and it'll be $507. And if you do want to pay, you can do that. Plus, you can add the indicators if you'd like to do that as well. This will give you the extras. If you want course package 2 with option 2, which gives you everything, come down here, put in that CAL15, and for that additional $30, you'll get the all the indicators that I showed you plus the bonuses, and it'll be $537. So that, let me make sure that I'm not missing any questions here. Oh, thank you so much. Yeah, I appreciate that. Let me pass this on. That's a really nice little testimonial here. Here's, let me plug that in. I appreciate that very much. Thank you, Kumar. Appreciate that very much. No, this is a totally different course there, Dave. I'm glad you did join me at the Wealth. Yeah, this is a totally different course. Now, if you would like to join us here, go ahead and sign up. Let me see here. I'm looking at what you've got. Yeah, this is a totally different course. So use that. I would recommend that you go in here and join us using this course package, package 1, option 2, whatever, right here. If you go down here again, this course is basically just based on the calendar diagonal. So just put in. Actually, what I'll do for you is just I'll let you join us for $97 since you signed up there at Wealth. I'd sure like you to join us for this. So let me do this. Let me send you some information after we get through here today, and then we'll take care of you. So appreciate you being at Wealth and joining me there, and we'll set you up with this course here for a little bit of a discount for you. All right, so that's kind of a review there. We'll go back through this a little bit more, at the end of the workshop here, but I wanted to get that out to everybody here before we move forward, in case you have to get outside and get things done before the bad weather hits you too hard. So again, everybody here today, if you want in with the 167, and this will give you actually today, like I said, because of the FUPA and the pricing, you'll get everything, all the indicators, the bonuses, etc. It'll be 167 for you. And then if you do want my alert service, You can do it with option 1, which gives you the live recorded course with those extras, 4 months to the alerts, 4 months to the trading club, 5 different alerts. So it'll be $507 today to pay. So, this is basically $100 a month for the alerts, plus then you add the course in. And then if you want with the option 2, it's going to be $437. So I hope that's, available and clear to you. So we'll move on from there. Now, in case you think maybe I've already purchased this course in the past, well, if you just go down into your members area and your personal account tab, you'll see everything that you bought from me. And if you see here calendar strategy, then you'll know that you did buy this in the past. But if you don't, then that tells you you do not have that course in your library. All right, so okay, 10 years, wow. Oh, that's interesting. So this was, boy, 10 years back. I'm gonna have to put that one in. So this was back 10 years ago. I was in Chicago doing an event, and Kumar was there, and we met. I didn't know that. Thanks for jogging my memory on that. So appreciate you being there 10 years and being here today. So appreciate that a lot. Now, the first, we were talking about earlier is the covered call. Now, this is kind of, the next one is the covered call with the protective collar. So it's kind of a income strategy where you get that downside collar put to protect your downside. So let's kind of build off of the covered call example. So, if you had the covered call and the call drops in value, and you own a put to protect the gains against the downside move, this is what's known as a protective collar option strategy. So basically what it is, it's going to combine 2 option strategies together, the protective put and the covered call. So the protective put, sometimes you might hear it called the Mary put, basically involves being long a put option and then long the stock shares. And then the covered call involves being long the stock and short the call. So you put those 2 together, combining those 2 strategies, and now you put on a protective collar to protect your shares that you own. So it's a really great strategy to protect downside, and you can finance it with that upside call. So reduce the cost of the collar, the cost of your cost of it. So let's go through how this works. Now, if your stock goes down in value, then what happens? The call option that you had sold against it goes down. That goes down, allowing you to buy back the calls that you sold at a cheaper price if you want, giving you a profit on the call options that you sold against those shares. So most likely, the short call options, that you sold are going to expire probably, unexercised or worthless, and you keep that full premium, or you might have to buy it back and still make money, but not the full premium that you sold it for. So that's one thing. If the stock goes down, you're reducing some of your exposure on the downside of the stock from the calls that you sold. So remember, you sold the call options at a higher price, right? Now, the second part of the protective put is our collars that the value of your put options that you bought, they'll go up in value. So remember, if you want to go short, a security or stock using options, how do you do that? Well, you can sell a call, or you can buy a put. So you were, protecting your downside from it going down by buying or being long a put option. So when that goes down, the value of your stock goes down, the value of that long put option will go up in value. So that's going to limit, to the stock shares value going down. That's going to offset a lot of that as well. And then the value of your underlying stock, would go down. So you've got that combination of the call. So if you have your shares here, Joe bought for, $40, and let's say he bought the sold shares up here, the 45 strike here, and then he bought, we'll show you in a minute, puts below at 39, he's got that protective collar, right? He's collaring that long shares there. So that's the beauty of that. So if you get in a situation where you want to get that downside protected, this is a really quick and fast way to do it. So let's go through this example, kind of illustrate this a little bit more detail for you. So Joe, remember, owns 500 shares of XYZ that he bought for 40 bucks. And then on the 19th of December, the stock then was trading at $45 per share. So Joe wants to temporarily hedge this position due to the increase in the overall market uncertainty and volatility. So what he does on this day, he goes out and he buys 5 of the 23 January weekly put options on XYZ, and he buys it at the strike price of $39 for a cost of 90 cents per share. And remember, one option contract is equivalent to 100 shares, right? And at the same time, though, to help finance those 39 puts that he bought, and he paid 90 cents, he went out and he sold 5 of the 23 January 49 calls above and brought in $1.10 per option contract. So this is, putting together that collar, and he's financing the long puts with the calls that he sold short. So here's the cost of implementing that collar. So he's got the 500 shares here that he bought originally for 40 bucks. He buys the 39 put, he paid 90 cents for that debit cost, and then he sells the 49 call against it to finance part of that. He brings in $1.10. So actually, in this particular example, his cost of the collar is actually a credit of 20 cents per share. So that's a really great deal for old Joe. He's really happy with that. And then his break even here is, 40 bucks less than 20 cents. So now his break even is lowered to $39.80. His max profit is going to be capped though at 49, but he's happy with that. He bought the shares at 40, and if it goes up to 49, he was going to probably be willing to sell them anyway. So that's going to be capping there at 49. So he's got those 5 contracts times 100. And then here's his cost here. He's got the 49 strike price there. He's got the 20 cents that he received there, minus the $40 the share cost there. So potential here, if he gets to 49, or if it keeps going up, he's capping here, he'd make $4,600 for those 500 shares. That's a 23% return on his capital. So Joe's happy with that. Now his downside is protected as well. So his max loss is going to be capped at $39. So here on those 5 contracts times the 100 to make it, equivalent to, a share price. He's got the $40 cost of his shares, and then the 39 plus the 20 cents here cost of that put. So his downside risk would be $400 on those 500 shares, or a 2% a loss. So that's a lot better than just a huge potential loss to the downside. So he's got his capped upside potentially make 23%, and he's capped on the downside to lose only 2% on that investment by using the protective collar. So that's a really great way to implement that if you're doing shares and you're doing covered calls, or even covered. We do a lot of using synthetic options where we can do it the same way. Now the next one is your vertical credit spread. So this is another really kind of popular income strategy that can be used to collect and receive income kind of on a weekly or monthly basis. I'm just looking at the questions here. Okay. Well, one thing that to look at, Kumar, would be doing synthetic covered call strategy. So those are a really great way to bring in income with a lot reduced capital at risk as well. So if we have time, we can talk more about it. And yeah, I will take a look at your other questions here in a little bit, make sure I get back to you on all this stuff. So let's take a look next at the 3 types of credit spreads that you can use. So first one is what we call the bear call credit spread. And the next one is the bull put credit spread. And then we've got the long iron condor. So the long iron condor is basically just a combination of using the bear and bull put credit spread together. Now, the bear call credit spread is going to be best used when you think the market is probably going to go down, but it doesn't have to go down. It could go just sideways and drift lower, or just kind of, churn sideways. But, so it can make money over time, even if that stock that you own stays stagnant. Okay, so the stock stays stagnant. So the strategy then is basically you're selling one call, and at the same time you're buying another call at a higher strike in the same option series. So that call that you're buying is going to cap the upside in case you're wrong and the market moves up. So you're not just naked short that call, which has, unlimited upside or unlimited risk. So the vertical bear call credit spread here is kind of what we call a negative risk ratio type trade. So in this example, let's say here you're short this call, the 1020 call right there. All right, and then that we're going to say has a delta of 20. Okay, so here we go back to the probabilities. So you sold that short strike there, delta of 20. So if you back into this, you've got a delta of 1 or 100, and you sold that short strike there, delta of 20. Theoretically, then you're starting this trade out with an 80% probability that the price at expiration is going to be below that short strike of 1020. So just kind of point that out. So you're short the 1020, and then you're long the 1030 to cap any potential upside. So if it keeps going up, you're capping your risk. And so then you can see the spread width here is $10, which would be $1,000. Remember, $10 times 100 to be equivalent to an option contract equals 100 shares, or roughly 100 shares. So your spread width is $1,000. And then you bring in a premium of 200. So that's your premium or your potential profit if it expires below the 1020. So you can see here, your risk though is the difference of $800. And that's what you would put up for margin with the broker until this thing is settled. Now, if you keep the full premium, at expiration, it closed below that 1020, then you make $200. And on the return of your 800 at risk, you're having a 25% return. So basically you can see here, we call this a negative risk ratio. You're actually risking $4 to make $1. And you would think, well, why in the heck would I do that? Well, earlier, 80% probability theoretically that price will close below 1020. So you've got a higher probability going into this trade of it being a winning trade. So your profit from that is reduced based on the higher probability starting out on that trade. So that's kind of the long and short summary of how the credit spread works and why it's a negative risk ratio. So here's an example of a bear call credit spread that we had done on Tesla to kind of give you an idea of what this would look like. So Tesla was at this time was trading here at on the 18th. It was trading right up here. Well, we'll go through the example here. It was trading right here at 243. All right, so let's go through here. We sold a bear call credit spread with the short strike way up here at 282.5. Just to kind of point that out. Now in this trade, then it was trading at 265 when we set the trade up, and so went out and sold the 282.5, 285 bear call credit spread. Okay, so sold that call there short and bought the call above it to cap the risk in case it kept going up. So the 282.5 short strike at that time, that was a 23 delta. So starting the trade out, then we had a 77 theoretical probability that the trade theoretically would close. There was a 70% chance of it closing then below that short strike of 82.50. All right, so that was on that point in time. Now on the 26th, now it was trading at 244.50. And you can see that the spread was now it made $50. All right, so it's up to $50 profit on that risk of your difference there. So that was a 50% or 25% return. So that's the credit spread on that. So you had a $2.50 wide spread. So $200 of risk. and you kept the full premium. So you can see down here in the analytics, you can see your credit was $50. And on the 26 now it's traded at 244.50, so it was way below that 282.5 strike. So it was worthless, and you kept the full premium. So that's the perfect scenario there for your credit spread, to keep that full premium at expiration. Now the next one is your bull put credit spread. So this is going to be the best one to use if you think the market's going to go down, but it still is one that can make money over time, even if the stock stays stagnant. So in this strategy, you're selling a put while at the same time buying another put with a lower strike of the same option series to protect, in case the market continues down. So you're not just short that naked put where you have unlimited downside risk. And so in this strategy, it's also a negative ratio strategy. So here, this is an example on Apple. Went short, looking for an upside on a trade move here, a bullish trade. So went short the 149 put, okay, and this had a negative 20 delta. So that's going to give you, starting out, an 80% probability of that price being below 149 at expiration, starting out. So shorted the 149, bought the 144 put below it right here to cap any potential downside. So if it kept going down, you're going to cap your downside exposure at 144. So that spread width is $5 between the spread, 149 and 144. So $500 wide spread. You brought in credit of 105 right here. Okay, so that's your premium you brought in. That's your potential profit or income. And the difference then is your difference of 395 is your margin you put up, and that's your potential at risk. And so if everything goes according to your game plan and it closed below 249, then you keep that full premium of $105 on your risk of 395. That's the 26% return. So risking $3.76 to make $1. And these are typical, returns that you can get, when you're selling, credit spreads, bear call or bull put, typically, 25, maybe 30%, depending on how far out of the money you go. But, basically if you do one standard deviation, that's kind of what you're looking at, kind of overall for these types of credit spread on the income you receive. But, if you annualize that and you're doing that, weekly or monthly or whatever, it adds up quite a bit and can amortize down, or, just, adds to your income over time quite a bit if you, annualize that. Now, another indicator that you'll get with this course is my extreme range band indicators. And so this is, showing you how we use this. This was an NVIDIA trade that we sold a bull put credit spread. So you can see NVIDIA here, it sold off really hard, and it was below this outer line band here. This is with the 3 ATR average true range of 3 ATR out. And so it was way down here. It sold off really hard, and then we got a cycle reversal. This is the other indicator you'll get. So this is a great setup for then selling an out-of-the-money bull put credit spread, because it's basically showing you that the market's getting ready to maybe shift and reverse back up. But it could take a while to turn sideways before it actually does it, but it's a good indication that it's getting ready to do that. So it's a great place to sell bull put credit spread, or like here, we could sell a bear call credit spread out of the money when we get extreme range to the upside. So this was the setup on NVIDIA, did a bull put credit spread here and went out and sold the bull put credit spread. It was traded at 99.66 and sold the 84.80 bull put credit spread, and the 84 short strike of the put had a minus 20 delta. So theoretically going in, had an 80% probability of this trade being a winning trade. And then on the 16th, it was trading at 124.87. So this was up $94 per spread, or a 30% return over that 11-day period. So you can see the spread brought in $95 credit down here, and then, bought it back for a penny. So 94% $94 per spread. That's one spread. If you did one spread, you made 94 bucks, 30% return. So pretty nice little return on that from the income side. Now the next one is your iron condor credit spread, and this is where you're combining the bull put credit spread and the bear call credit spread together. So when you're going to use this one is if you feel the stock that you're trading or security is going to trade in a very tight range, maybe between the two short strikes of these spreads, and kind of stagnate there and go nowhere, you know. So it's a great strategy for when you see a security or whatever trading sideways and really cap from an upside resistance or downside support, just kind of churning. So the iron condor then is ideal for this, for premium collection, where you seek to minimize your potential losses in the event the stock moves, you know, adversely one way or the other, either up or down. And again, this is going to take advantage of the time decay and the volatility crush of your options as they go into expiration. So your iron condor profile basically looks like this. So you're short a bear call credit spread, okay, and then you're short additionally a bull put credit spread together. And it's a great strategy because you can leg in. You could, you know, if you could sell, you know, let's say the market goes up, starts to stall out, you could sell that bear call credit spread first, then it pulls back a little bit, and then it goes sideways. Then you can sell that bull put credit spread down there. So you can leg in, leg out, or, you know, do it all at once. So basically you're getting to double the premium. So let's say this is a, you know, $400 wide spread, right? Something like that. And let's say here you bring in 50 bucks and you bring in 50 bucks on the put side. So you brought in a total of $100. And so you can see then your risk is 300, and you keep that 100, you can see you're doubling your return. So this can be a really great strategy if you think the market's got a really good heavy resistance above or heavy support below. Then you do this strategy for it to churn sideways. You keep that full premium, and you know, it's a good probability trade for you, and you're getting double the premium versus just selling the credit spread on the call side and put side. So here's an example of one that we'd set up with Tesla. And Tesla, you know, had a really good kind of a range bound, and here you can see a lot of resistance up here, and then it had this kind of support area down here. So it had been kind of range bound. So went out and did legged into a iron condor credit spread. So with this one being legged into leg one, to kind of start out, was we did a bull put credit spread. So Tesla had moved down a little bit and then started to pull back up. And so when it started to reverse back up, sold the bull put credit spread. It was trading at 243.30. So went short the 237.5 put, long the 235 put below it. That 237.5 put at minus 20 delta. So we started out with 80% probability looking at that. And then you can see it was collected or brought in $60 credit there. You can see right here on the 18th, that trade was up 24%. Just that part of the trade, the credit dropped down to 14 bucks. So this was up $46 per spread. Now that was just that one leg side, okay? And the other side of the trade though was adding the bear call credit spread to it. So this is leg two of the trade. And this was selling it was at that point trading at 253. So sold the 267.5, 270 bear call credit spread. The short strike here had a 23 delta. So we, you know, looking at our probabilities of 77% chance that it would be below. So sold that call, bought the call here on that credit spread, brought in $38 there. So the combination of the two together, then we had the iron condor, where we had a potential max profit of that total credit brought in of $98. All right, so we had the 267.5, 270 bear call credit spread, the 237.5, 235, and those were the deltas. Okay, so it looks like this, right? And the combination of the two together, we had the 60 bucks from the put credit spread, and the other had the 38. So we had a total, if it goes out between the two strikes, of $98 per spread. On our risk of the difference would be 152. So you can see it's a $2.50 wide spread. We brought in a total of 98 bucks. So potential risk is the difference of 152. That would be your margin you would have up with the broker in case things fell apart. And you've got $98 per spread. Potential return here would be a 64% return. So that's a really nice little income return on that. If you get it to go out between the two short strikes, and that's, where this one actually ended up right here. So you can see down here, the credit spread, you had the put credit spread at 60 bucks, bought it back for 4. So here's your profit there. And then you had the bear call credit spread you set up at 38, bought it back at 3. Your total profit then was $91 per spread, or a 60% return over that 7-day period. So that's how you can kind of combine the two together and double up on your premium. Now, this next one is the butterfly spread. So this is a really great one as well. And this is one we do quite a bit of, these butterflies and long condors, which are very similar. But the butterfly spread can be constructed for very low risk, but really high reward type of returns. So great for directional, kind of trades, or kind of non-directional in a certain extent as far as the way it works. Now, basically what it is, it's a combination of a vertical debit spread with a vertical credit spread. So you've got a vertical credit spread, but instead of having two credit spreads together, like the iron condor, you're going to have a credit spread combined with a vertical debit spread. So this really increases your profit potential from the vertical debit spread side, which has a positive risk ratio. So we're going to get a positive risk ratio, good positive return with the debit spread side, but with the credit spread side, we're going to reduce the cost of the debit spread plus reduce our theta, making this also what we call a positive theta trade, no time decay. So the butterfly is a really great trade for very limited risk, but high reward. Okay, so really great strategy. And basically, it has what we call 3 striking points or prices in the butterfly spread, and that's why it's called the butterfly, because the body is where you have the short strikes. So you're basically selling short time and short volatility, and the trade results in a debit cost trade. So here's an example, one that what it would look like. So here, let's say you're long that call here at the 1010, you're short that 1020 call. So you've got that spread with $10 wide, and then you sell another 1020 call, buy that 1030 call. Now you've got a butterfly, balanced butterfly. Both sides are $10 wide or $1,000 wide. You had here, let's say here on the debit spread side, this cost you $300, the debit cost of that debit spread. And here you brought in a credit of $200. So that combination then reduces your risk to $100. So in this spread, $1,000 wide or $10 wide or $1,000, you have a total cost then reduced to 100. So the difference is your potential profit of 900. So if it was to go out here, what we call the top of the tent right there, you keep the full $900, and on that risk of 100, then you've got a 900% return potential on this kind of trade. So the butterfly in certain situations can be a really good one to add to your arsenal. All right, now 5 is the income calendar. So this is where we get into these two strategies that are really, really dynamic that we use a lot of. Now, first off, though, the income calendar is kind of the first component of the calendar diagonal. So basically, this is a medium to long-term, non-directional type of option strategy to use, but we use it kind of more directionally, but it's a really, really low risk way to trade a directional trade, target, kind of what I call a targeted trade up or down, where we can have a very little at-risk debit cost, but have a potential for a nice big return off of the trade setup. So this is where we start, and then we add a diagonal spread to it to make it the diagonal. So we'll start here, and then I'll show you how this kind of morphs into the calendar diagonal. So the income calendar then is a kind of a neutral option strategy that profits from the underlying stock that you have that you're trading remaining stagnant or trades within a tight range, kind of like the credit spread. Now the profit comes primarily from the difference in the rate of your premium decay and the implied volatility collapse or crush between the near-term short strike of the option you're going to be short in the near term, closer to expiration, near-term expiration, and then your long, the longer-term option, you're long a leg further out in time versus your short leg closer in. So this is possible because remember, if you're short, your near-term option premiums are going to decay at a much faster accelerated rate than your long-term option that you're long. Okay, so you're going to be long, but you're going to be short against that long in a shorter duration option series, so it accelerates really fast. So it's an excellent strategy when you expect your stock or security to stay stagnant, again, within a tight range. This produces income from the time decay. So it can be used as a target range-bound trade, really great for market conditions when you want to keep a long-term position, long-term stock, long or even short. You want to keep a long-term position for a particular stock or ETF, but you're expecting it to eventually break out either upside, but then your downside is protected. So it's like a great strategy when you've got the market kind of churning sideways on a bottom, and then you think it's going to eventually turn up. So you can do a calendar setting a target. It could be for an upside, moving average or Fibonacci level, and you set it up there, but maybe it keeps turning sideways. So you can keep, adjusting this like a covered call. You just let that option that you're short expire. You add another one to it. Anyway, I'll show you an example here. So basically, the strategy then allows you to get paid while you're waiting for the long-term breakout. So remember, you're going to be long your option further out in time, and then you're going to be short closer in, so you can play the accelerated theta decay of your short option, keeping this long option intact. And then if it does turn, you can just let it ride the long end, close out the short end, and go from there. Or what we'll typically do is convert these to debit spreads or condors or something like that. So here's a really good example, just kind of illustrate the profile of what you're looking at. So with the calendar, you can use weekly options or monthly options. So let's say you've got what's a good example here? Well, let's say, let me pull up, hold on one second here. Let's say we'll take a look. Let's kind of theoretically say we want to play Apple. All right, and let's say Apple's trading at $250, which is right about where it is. So with a calendar trade, and let's say Apple is trading right now at $250. Okay, and we think that we're looking at the charts and everything, and it looks good for a move to $260. Okay, so what we can do, but the Apple's come down and it's starting to base. It looks like it's starting to bottom. So we think it's going to bottom, and then our next target point based on some moving averages that are coming up resistance or Fibonacci levels would be 260. All right, so we go out and if you do a vertical debit spread, let's say you do one. So let's say you want to do a vertical debit spread. So you go out to this is the difference. You go out to the 4 Feb option series, and that's going to be 11 days to expiration. Okay, so you do a vertical debit spread. Okay, so you'd be long a call and short a call, right? Vertical debit spread, both the long and the short strike in the same series, the 4 Feb series, 11 days out. Now the difference with a calendar is that you're going to do this with different time frames. So you're going to go out, let's say you go out 60 days out here, and you buy the $260 strike. Okay, So we're looking for a target up to 260. It's trading at 250. And, we think it's going to move to 260, but it could take some time. So we start this trade out going way, we could go out, let's say we go out to the 20 Feb, and we go out to the 20 Feb option series. That would be about 27 days out. All right, so we got a lot of time there. We go way out here. We buy that 20 Feb series. We buy the $260 strike there. But instead of doing it like a debit spread, something like that, we sell closer in. We sell 30 days out the 260 strike. All right, so we've got the 260 strike short there, but we've got that short 30 days in. So just let's say we did that 30 Jan. I'm not sure if that comes out exactly right. So that's going to then have a faster accelerated theta decay, right? So that's the beauty of it. So then if if we don't get to 260, then what we can do is we can go to the next series. So, currently right now, 30 Jan would be next week. And if we don't get to the 260, then we could sell the next series out. We could sell the 2 Feb against it. All right, we could sell the 260 again. So basically, this is what we call it, a horizontal trade or income strategy, where you just collect that premium, and eventually you think it's going to make it to 260, and you just keep collecting that premium over and over and over. So that's the basis of a calendar strategy or income strategy. But then when you add that with the directional a spread, the diagonal, that's where you really get some really powerful trades. So here's another little illustration of how the math works. So let's say you go out and you're long the 30 Jan $60 call, so 30 days out to expiration, and you shorted the 23 Jan $60 call against it, but this is going to expire in 6 days. All right, so that's going to have a faster accelerated theta decay, right? That's what you want to play. So these are open for a debit. So this is going to benefit from the implied volatility crush going to zero at expiration. And especially if you have a positive horizontal skew, which we'll talk about. Also benefits from the accelerated time decay, that theta decay, because that closer in series, the 23 Jan, is going to have a faster accelerated time decay than the long data that you're long back here, the 30 Jan. It's going to accelerate, it's going to decay at a much slower rate than this closer in has accelerated theta decay there. So faster time decay there than the one that you're owning. That's really the basis of how it works. So the option contract then with 6 days remaining is going to decay in a value at a much faster rate than the same strike option contract that has 13 days remaining. So that's how that accelerated time decay is going to benefit this trade. All right, so let's say you did this and you had that 30 Jan 60 call when you set it up, was $400 per contract. That was 13 days out to expiration. At the same point in time, you sold short against it, the 23 Jan 60 call, and brought in $100 credit premium for that. That has 6 days. So it's going to be a faster time decay, accelerated theta decay. Now this is then done, you see it's done for a $300 debit. You had a $400 cost here, you brought in 100 here premium, so your debit cost is $300. Okay, so if let's say the stock trades sideways, then the closer to that 23 Jan expiration, that 23 Jan 60 call, then it's going to be lower in value due to time decay, the accelerated time decay, versus the Jan 30 call or 30 Jan long 60 call is going to have maintain its value in this example because there's a very slow time decay there. So we're trading that timing issue between fast accelerated theta decay versus the further back long that you're long there. So you can see here then if you paid $400 originally starting out, and then that that short strike 23 Jan now has dropped down because of time decay from $100, it's decayed down to 50. So you can see then your profit 400 minus 50. Now you've got your spread value 350. You're up $50, right? So that's how it works. It's kind of like a credit spread, but it's a debit pay cost trade. So you've got a return of $50 profit on your original cost of 300. So that's a 16 or about a 17% return. So that's a pure calendar trade, how it works. But then you add the next part to it, and this is where it gets really very exciting. This is the calendar diagonal. So with this trade, before we get there though, you can see here is what we call a positive theta decay and a positive horizontal skew. And this is a big benefit to the calendar trade. So you can see here, this is Gilead, just an example. It's traded about 72.66. And so you can see here the 28 Feb series, 1 day to expiration. If we look here at our 73 strike, you can see that the theta is 34 cents minus 34. So that's 1 day. It's got the next day, if it doesn't move, you just put 34 bucks. You just made $34. So you can see the theta here's 34 on this 1 day at expiration. So huge, theta decay. What you get 34, but look, see right behind it, the next series, the 6th March, 8 days expiration, that same 73 strike, the theta on it is 16 cents. All right, so that's what we call a positive theta, a positive delta, theta delta of 18 bucks. All right, so basically, if you did a calendar and you're long this 73 here and short that 73 there, and it doesn't move the next day, you just made $18 because you made the 34 there. You had a cost there of 16, so the difference is 18. So that's what we call a positive theta differential. That's one positive aspect of it, just to show you kind of one of the benefits, how it works. And the other one is your positive horizontal skew. So sometimes when we get higher, implied volatility, when markets go to really extreme ranges of uncertainty, you get a higher implied volatility in the front end of the market versus the back end. Everybody's more concerned. Or when there's an earnings trade, when you have an earnings release, your front option series is always going to be higher implied volatility versus the one behind it. So that's what we call positive skew. So you can see here, just on this option series here, this 28 February 1 day at expiration has an implied volatility skew. It's 92.22% implied volatility. The series right behind it has an 87.58. The series behind that 69.35. So you can see this is what we call a positive. So it's higher than the series behind it. All right, so you can see way down here, 69.35, and this one's 92. So almost a 30 basis point difference. That's a positive skew. So that's also a benefit when you're doing horizontals. So your income counter spread then is going to reach the max profit potential is when the underlying stock closes at your strike price of the short dated option series. So that's your max profit. So these are great for little targeted trades. Like for example, in that Apple trade, if it got to that 260, that would be your max profit on that type of trade. So here's, just to show you what we've done on these types of trades since we started since I started sending these out as alert. This is the calendar diagonal alert service part. Started doing these on the alerts, started sending these back out in June of 2019, and through yesterday, we've had 396 trades closed out. 279 have been winning trades, 29 break even, 88 losing trades, right at about a 78% win break even rate. Again, these are just unaudited summary results, but that's what we've been doing. So really high winning probability of these trades, very selective with them, but these give you a lot of flexibility. So let's go through and look at the calendar diagonal. So again, this is probably one of our favorite strategies. Now with this one, remember what we just reviewed with the calendar. So it kind of starts out with a calendar component, but then adds a diagonal kind of spread component to it. So again, it's going to be a medium to long term. Now you can go out and do these with leap options. I mean, you can go out with this type of strategy And if you were doing, you're super bullish or something, I'm just kind of showing you this. You could actually go out with Apple. I mean, just as an illustration, and you could buy way out time. You could go out here to the 15 December year 2028, and you could go long the leap options out here with, 1,056 days until expiration. So you could be long a calendar or calendar diagonal out here. So you could be long a call way out here in time, and then short, something closer in the February, 4 Feb, 6 Feb, 9 Feb, something like that. So, a really cool strategy. Or, what we'll typically do, what we do a lot of these trades is kind of a intermediate type of swing trades where we'll be, hold on, let me get rid of this. So we'll be like, just playing like a 14-day spread or 7-day spread. So we might go out and just buy the February 4 series, be long that, and then short against it the 2 February series. So what this is doing, instead of being like long a call debit spread in the 11 in the 4 Feb, where we're long that call here, short the call here, and that one series, we're going to have a negative theta decay. But if we go in and we sell instead, we buy the 4 Feb call, 4 Feb series. So we're further out, 11 days out. And then we sell the closer in, the 2 Feb right here, 9 days out. We're going to get, this trade is going to give us then from this having a hot more time decay, we're going to get a bigger positive theta on this trade. So this ends up being a positive theta trade if you do it that way. So that's one of the main big benefits. And then we can just, roll it, do a lot of different adjustments and things like that, depending on how far out we go with the long dated side. So basically, just in summary, this is a vertical diagonal debit spread. So you're going to be, your long option leg is going to be set further out in time, like that calendar. But the short option leg against it is going to be set closer in time. So it's going to have that faster accelerated theta decay. You're going to have more positive theta here, which offsets the negative theta decay on the debit side. So this takes advantage of that short-term weakness or strength that potentially you think is going to eventually in time revert and cycle either back up if you're doing this call base for a call counter diagonal, or you could be doing it for a downside move using a put counter diagonal. So this provides you time to let the directional trade kick in. So again, just think of this situations where you might have a market that's been, big sell-off, and you think it's starting to get a really good bottom, but you're not sure exactly when it's going to turn up. But you have your basis of the trade, your theme to this trade, your bias is that it will eventually turn. So you could, like for example, but if it could take a bit of time. But if you go further up, far enough out, you can just buy that far out time, keep selling premium against it until it finally turns up. So again, a good illustration for this would be just, I'll pull up that option change. So just kind of conceptually think about this. For example, if you not saying Apple was one, but Apple's actually been selling off pretty good. So let's say Apple's come down, you think it's going to eventually turn, but you know where it's just turning sideways. So you could go out way out here if you wanted, buy way out here, and then sell here. It's like a covered call. You keep that premium. You keep amortizing down that long dated, and you sell the next series. If you don't get there, the next series, the next series, the next series, the next series, just like a covered call. But you're going to have a fraction of the cost from buying that long dated option in the far out time frame versus buying the actual shares. So that's one of the big beautiful benefits of the calendar diagonal. You can do it with the put side as well. Yeah, always use the expected implied move. And what is the recommendation with the diagonal? Well, okay, so so typically about usually like a 20 delta on the short strike. So good question. Let me put that in the box here. Yeah, this is typically I will look for like a 16 or 20 delta, that one standard deviation price point out. So if you're doing a debit spread, you're looking, typically you're buying at the money. So that'd be like a 50 delta on the long side of it, and then you're typically on a debit spread, you're going to sell, you're long the 50 delta and usually a lot of times short against it, like a 30 delta or something like that. So with the calendar diagonal, what I typically will do is I'll look to do the long dated side. I'll buy that typically around right at the money. So that's going to be a 50 delta. And then I'll sell the short dated. I typically look to sell that around a 20 delta because I don't want it to hit, I don't want it to go through that short strike. So, a 16, 20 delta, I'll just have to see where the premium is. And that's kind of where I will look at the delta of it. Hopefully that kind of answers your question there. Okay, so the other question that was just given to me was, how do you choose the strikes for your calendars? Please explain, how do we choose your strikes? Okay, that's basically how you choose it. And then I'll also look at the chart, so for example, I'm just kind of pulling up Apple for some reason here. But first off, then, I would look at the delta of a 16 or 20 because I don't want to have my short strike hit. I want to keep the premium. And then I look at my charts. And so, with Apple, you can see my next big resistance area is going to be probably up here, this moving average. That's the 21 exponential. So I'm just kind of throwing out what I would look at. Not saying I would be doing this one, but I would probably be looking at the short strike, if I could, right above that 21 exponential, somewhere up here. So I'd be going long. If I was doing Apple, it's trading at 246. It doesn't have a short strike. I mean, it doesn't have a 246 strike, so I'd be probably buying this one, being long the 247.5. Just kind of throwing out example, and then short against it up here, probably that 257.5, something up there. But roughly in general, though, like I said, the 50 delta for the long side and the 20 delta on the short side. Okay, so the trade construction then takes advantage of that accelerated time decay characteristic from the front short dated option, right? That decays at a much faster rate than the back dated, long dated part of your option trade, plus the positive implied volatility difference between the two series if you do have that positive skew, which is not not necessary that you have it, but it's just that's another advantage. But the big advantage, the big benefit of this kind of strategy is that you've got that additional vertical spread component that adds that directional element for really potentially great profitability. So again, this is a strategy where you're buying options at a discount. So again, think about it like a covered call, but instead of owning the shares, which could be like, oh, Joe, he bought those $40 strike, $40 a share, right? So that's if you bought 100 shares of that, that's what, 40,000 or $4,000 for 100 shares there, versus if you were to, for example, Joe has $40 a share. So if he bought 100 shares, that's going to be a cost of $4,000, right? And then Joe was selling the options above it, and bringing in $100, something like that, right? Credit. Okay, so if he keeps that $100 once, one series, one cycle, then he just amortized his cost down by $100. So now that's that's one way to look at it. So now he's starting to amortize that down, and he has just reduced his cost now to $3,900. Okay. But here's the beauty of it with the calendar diagonal. Sometimes you hear it called the poor man's cover call. I call it the smart man's. Instead of paying $4,000 for those shares at 40 bucks, Joe could probably, those $40 strike price way out in time, that might cost him only $100, or something like that. Or maybe it cost him $200. Well, let's just take a look. So just for example here, I have Apple up, and this will be just to show you the difference. So let's say you're going to buy 100 shares of Apple, and you're going to do cover calls or whatever. So you go out here, Apple's trading at $248 a share, right? And you buy 100 shares to make it equivalent to one option contract to show you the difference. So you're going to have a cost here with Apple. If you bought 100 shares of Apple at $248, your cost here is going to be $24,800, right? All right, so that's going to be your cost, and then you sell calls against it, et cetera, et cetera. But what if you were to, instead of buying the shares outright, you went out here, and let's just say we went out and we went to we could go all the way out. Let's say we went out here to the 15 December, and we bought Apple, we bought that 250 strike. Let's say we bought the 240 strike right here, and we paid 62 bucks. Okay, so let's say we did that. So what is that? That's going to be, instead of that's going to be, let's say you bought $62. You got one contract for 62 bucks. That's equivalent to like 100 shares, right? So you just paid $62 per share, per contract. And so that's 62. Oh, hold on, let me get rid of that. So we pay $62, so that's $6,200, right? Versus $24,800. So huge difference, right? So that's just kind of one way to look at it, the difference between this. Counter diagonals, and then just depends on the time duration that you're using. A lot of different ways that we do this, the flexibility. So, but overall, in general, you can see that the difference is huge. If you bought 100 shares of Apple and you're trading that to, up or down, doing cover calls, that's 24,800. If you want to do something similar, we could do it with a counter diagonal. If you're super bullish on Apple, you could go out to that 15 December all the way out to 2028, and you could buy that 240 strike. That's going to cost you $6,200. Okay, so you see the difference there. It's just a fraction of the cost, and then it's a question of how do you manage it? What do you do when you do the different setups? Okay, that's what I'm going to teach you in the course. So that's like 25% in that situation. Some of them are much even cheaper than that. There's a lot of different things we can do. It's just so dynamic and so flexible. All right, so then you've got that way, and so you're then discounting. You sell premium against it over and over. So that's typically that's the formation. So again, like here, instead of doing a vertical debit spread all in the same series, like just here you bought you bought a call here at the $150 call, and then you sold up here a call against it at 200, right? So you've got a call debit spread, 150, 200. Instead of doing that in the series, out here, whatever, let's see here, next series out is the 30 Jan. Instead of doing the 30 Jan call debit spread, we could go out, well, the Apple thing, we could go out to the 15 December series, 3 years out, buy that 150, I'm just throwing an example, extreme example, and then sell against it the 30 Jan So we bought the 150 calls, sold the 200, and we do this with the options. And let's say this cost us, 150 bucks, and we bring in here 25 bucks here. So we start amortizing that down, and eventually we'll be down to zero at a much faster rate or pace than if we bought the shares. So think about it. If you bought 100 shares of Apple and you paid that 24,800, okay, how long is it going to take you to amortize that down versus if you went out 3 years and you bought one option contract and it cost you $6,200? Okay, so there's a huge, you can see the difference, the benefit there from it. But there are a lot of other things to consider, a lot of additional things that you need to know, and that's what the course is going to cover. So here are a couple examples of ones that we've done just recently. This was on one we just completed. This was Chevron. This was an alert trade. This was a fantastic one. So we did this alert trade. This was just a recent one. We just finished up this trade on Friday, but we'll walk through that. I'll show you. We'll walk through this trade. So went out, and this was went long Chevron. Originally started this as a call counter diagonal, and entered the trade on the 8th of January. At that point, it was trading at 157.25. All right, so this is, just to show you the alert that was sent out. We use a service called Telegram, which is a free app, and it goes out within seconds. So here it says new Chevron long. It was trading at 157.25. I go through, the trade setup, why I like it. So it says daily cycle low, retracement reversal off the 50 simple moving average, breaking above a prior week's high. Daily positive momentum, upside momentum cross target 1, 160, target 2, 164, know your risk, etc. So went out, the original trade sent out was to buy a diagonal, and going out to the 23 Jan, and then buying, let's see here, buying the 23 Jan, and then selling again, buying the, let's see, what did we do here? We bought the 26 Jan, and then sold against it the 23 Jan. So we had the 157.5 call, 165 call counter diagonal. Okay, so I'll show you this in a second here, so it'll be a little bit more clear to you. 1 second. Okay, so let me back up here. Okay, here, I'm sorry, here it is. So this is went out and bought the 26, hold on. Yeah, here it was, bought the, let me back up here. I'll show you the exact trade here if I roll forward here. So we went out, we bought the 23 Jan, 157.5 call, and then sold against it the original trade when we set it up, and then had sold against it the 16 Jan, 165 call. Okay, so you can see that spread there. So long the 157, but that's out in the 23 January series, and then sold against it the series, the series right before it, the 16 Jan. So just the spread between, just kind of a 7-day spread, basically. All right, so this is the original trade setup. And then this thing really started to take off. And so that was the original trade, going out and being long the 23 Jan, short against the 16 Jan, 157.5, 165. I said, go do it around 250 bucks, 250. And then on the 9th, it was trading at 162.20. This trade was up about $226 per spread. And then what we'll do is when we get a certain point, if we can, we'll adjust the trade into, usually a debit spread or sometimes a condor, and try to make it into a free trade. And that's what we were able to do on this trade. So then you can see on the 13th of Jan, now it had blown and was trading at 165.40. So I sent out this alert. I said that if we had one adjustment already, so we adjusted it to being long the 23 Jan 160 call and short the 165. So what we did here is we bought to close the 16 Jan 165 call. We had a really big profit in that, and that was a short strike. So we bought to close that, and then we sold open above it, higher, the 167.5, and then sold to open the 23 Jan 172 180 call spread. So with this trade, I'll show you here in a minute, we adjusted this to a long call condor. All right, so we ended up then long the 23 Jan 160 call, short the 23 Jan 167.5 call. That was the debit spread side, and then against that is shorted the 23 Jan 172 180. All right, so let me make sure this is clear for you. So what we did here, let me just back up and make sure it's nice and clear. So we were long that 23 Jan 160 call, short the 16 Jan 165. So what we end up here, when we originally started this trade, you can look back here, we were long the 26 Jan 157.5 call right there. But it had gone up so much, we had a huge profit from that long 157.5 call. So what we did, we sold to close that, and for a big profit, and moved the long strike up to the 160. So we locked in a huge profit. I don't have that adjustment in here, but then this was the next adjustment here, is where we adjusted to the condor. So we were long coming in the 160 call that we had adjusted up, short the 165 call. And then what we did, we bought to close that 16 Jan 165 call right here. Okay. We wanted to roll the short strike up because it was moving pretty fast. And then we took a small loss on that. And then we sold to open the 167.5 call further up. Okay, so that was one step. And then the next thing, we sold open then that 23 Jan bear call credit spread, the 172 and 180. Okay, so then ended up with this adjusted trade. So long now, the 23 Jan 160 call, short the 167.5 call, everything now in the 23 Jan series. And then that was the debit spread side, and then added that credit spread side in the 23 Jan series. 172, 180. So that made a long call condor like this. And we recouped our full cost of the trade, and this was now a free trade. So I hope I didn't lose you on that, but that's kind of what we did on that. Yeah, okay, so Kumar, I see your question. Hey, Kamal. Hey, I haven't seen you in a while. Glad you're here. Question, if one was expecting 7 to 10% market correction in the next 4 months, what strategy would you look at in VIX or SPX, SPY, QQQ? Well, if you were thinking there's going to be a 7 to 10% correction, that you could do a put calendar diagonal. You could do things like, something like this, where instead of you buy a put way further out in time and then start selling short dated puts against it. And then you could play it like that. That's one thing you could do. That'd probably be a pretty decent strategy if you're thinking of a correction. So your basis for the trade would be, okay, I think it's going to go down. I want to get some exposure now. So I'd go out, I'd buy, puts on SPY or SPX further out in time, like I was showing you here with Apple, and then start selling the puts against it, and then just start collecting some premium, amortizing down your long dated put, and go from there. With your basis of the trade, your theory is your bias is that it's going to eventually be down. Okay, that's one way to do it. So here's the Chevron trade. So we bought it right here, okay? And then we had a really beautiful move up to this area here. So on yesterday, it was now trading at 167.80. So the original trade, we got into it was here. We were long that 23 jam 157.5 call, short against it the 16 jam 165 for 244 bucks. And then that spread moved out to 470. So you can see here we were up 470. The spread, our cost was 244. So just right here on the 9th, this is a straight calendar diagonal. It was up $226 per spread. That would be one spread or 92% return. But what we did, remember, this thing ripped up to the upside. We were originally long at 157.5. So we sold to close that, took a huge profit, rolled our short strike, not our short strike, but our long up to the 160, and then it's kept going up, okay? So that was able, we were able to take advantage of it, locked in a no-cost trade by doing that. So we ended up with this, this structure here on the 8th, adjusted the trade. It was then trading at 165.40. So we had already, like I said, adjusted it where we sold that 157.5 and rolled up to the 160 on the long dated, locking in a big profit. So now we're long the 160, call short the 167.5. We rolled everything into the 23 Jan series. So we're long that call debit spread at a really nice, low debit cost. And then we sold the 172.5, 180 call credit spread against it. And the credit we brought in on that side reduced this trade to zero risk. So we actually reduced it to a credit of, we had $2 credit. All right, so potential then, if it goes out in here between the two spreads, potential would be to make $752 on a per spread on zero risk. Or if it went down or went up, if we did nothing, we'd make $2. Okay, so that's just kind of how it rolls out. Now here's where it was on Friday. Sent an alert. So if you stayed with it, some of the alert members did. So on that 13th, it was trading at 165.40 when the adjustment was done, and then yesterday trading at 167.80. That spread you can see was blown out to $731 per spread, plus the credit of $2. So the spread was up $733 per spread on zero risk. Okay, so if you did one spread yesterday, that was up $733. Theta, zero theta, and it has positive theta on that. All right, so that's a really awesome trade strategy. Here's just one more to show you. This was one we did on Walmart. And again, this was looking for a cycle low retracement upside move. This was a really beautiful trade setup. So we did this one. Walmart's trading at 105.50, and everything was looking good. What I call cycle low retracement reversal off the 50. Good momentum. We were looking for a target 106, 107. So the original trade went out and we bought the 12 December and then sold against that the 28 November. We did the 105, 107 call counter diagonal. Okay, so I sent that out about $1.95. And anyway, let's go through the trade. So you can see here on the 15th, this trade then was up. Now it's trading at $505 per spread on the upside. And we also adjusted this trade. We adjusted this trade into a long debit spread. So we had a long 107, 112 call debit spread for zero risk on this trade. So when you get these things that move and you want to do the adjustments, that's a big part of the course. I'll teach you how to make these adjustments into these kind of free trades. So that was about as perfect. Look at that trend up. So that was just incredible. So we got into this trade right there, and right there, right above that 50 simple moving average, cycle 1 and 2 positive momentum, broke above that, started trending, just kept with it, did a couple adjustments, and then we had that on the 5th, we had already adjusted to that long call calendar diagonal to condor, and it was trading at 115.60. Let's take a look. Let's go through it. So the original trade we had here along that 12 December 107 call, short the 5 December 112. But now we've done a couple of adjustments. I'm just showing you where it was at this point in time. So when I do the alerts, I'm constantly keeping you updated on if we do adjustments, I send those out. So anyway, we ended up with this. When we got into the trade, it was trading at 105.50. And then we had a couple of adjustments, and now it was trading here at 110.51. And we had this profit here. Now we were up 183 just on the spread. So it went from 174 to 357. So we were up 183, 105% return on that. And then what we did was we adjusted this to a just a call debit spread. We were able to do that. We just left it here. We had this adjusted into this 12 December. We rolled everything here. So now we were long the 110 call, sold against it the 116. So we're long the call debit spread here, 110, sold the 116. And this was all rolled the whole trade into that 12 December where we started the long dated part, and we had a credit of 22 bucks. Okay, so I can back up and show you. So now that spread had blown out to 284 plus the $22 credit. So it's up $506 spread on zero risk. So I'll back up and show you a little bit more. Not able to put all the adjustments in, it would take forever, but you can see here we were the original trade. We're long. Let me go through here. So the key to these trades is where you start out with your long dated the duration. So this was a 12 December, right? We started out there 12 December. That was the long dated. We started out long out 12 December, the 105 call, and then it shorted against it the 28 November 107. Okay, and then it was moving up. And we did a couple adjustments, and we had that 12 December 105 call, short the 5 December. Now we adjusted it, so we closed out the 28 November. Now we had rolled into the 5 December, and we're short now the 5 December 110. So we rolled up the short strike. So we went from 107, we rolled that up to 110. So we're long the 105, 110 in the 5 December there. So then I said, make sure it took some profit, then adjust the balance. So what we did here, then we bought to close the 5 December 110 call and then sold to open. We went to the next series, that 12 December, where the long data was. See how we ended up in the 12 December and then sold to, we bought to close the 5 December 110 call, and then we sold to close the 12 December 105 call because we had a huge profit. So it was trading at 109.80. So we sold to close the 105 call, took a big profit on that, and then bought to open, rolled that long leg up and rolled that up to the 107 call. All right, so now, then the next step was sold to open the 5 December 112 call. Okay, so see what we did? So we went from that long 105, had a big profit, rolled that up to the 107, and rolled the short strike up to the 112. So we end up now long in the 12 December series, 107, 112 call debit spread. And we were able to do this based on that big profit. We were able to do this for a profit and get into this for actually a $22 credit. All right. So that's kind of the beauty of it. Actually, it was we ended up with the 110, 116. Okay. So, today, I just wanted to give you, better education on the great trading and investing advantages of options. And I, just gave you a little overview of, the basic option income strategies that you can use to generate income, to give you an idea of, some of the different ones out there and get you up to the ones that may be of interest to you for your risk, profile and your trading capital. But this was just kind of a start. So if you would like to take the next step, then I'm doing that course where I'm starting next Saturday, the 31st of January. I'm going to be doing a live and recorded workshop that's going to be just strictly focusing on these two strategies, the income calendar spread, and then the biggie is how we make that into the calendar diagonal for upside downside moves. And there was one question that Kumal had about a longer dated put strategy. So if you want to take the course next weekend, I can go through that example to show you kind of a way to do that using a put calendar diagonal. So we could go through that example as part of the course. So if you'd like to join in, hopefully you will. Here's what we've got for you. We went over this kind of briefly at the start of the course today workshop, but we'll be doing this, the calendar nirvana, the master's blueprint for buying options at a discount, calendar and calendar diagonals. So we'll start out next Saturday, part 1, 11 to 2, and then we'll finish up Monday, part 2, 4 to 5 p.m. Eastern, and then we'll have a dedicated Q&A the next day on Tuesday. All right, so this will be a 4+ hour. I've got their 6 enrollment bonuses. Now, for everybody today, it's $167. And that gives you all the bonuses because the payment, link, the price didn't come up correctly. So hopefully you'll take advantage of that. And so for today, if you do course package option 1, it's $1,600 value as far as the workshop itself. And then, so the course is $197, but with the discount, 50% off, it's $167. And with this, you'll get the trial membership to the trading club, follow-up Q&A, option trading tutorial. So, all those extras, but $167. But for today, everybody that signs up, you will get the option 2, which gives you the other 6 bonuses, plus the 2 trading indicators and the bonuses. So with this package, it's $197, but like I said, we have that price points kind of messed up. So it'll be $167 for you. And with this, you're going to get, everybody will get my cycle reversal indicator that we're going to use in the course. You'll get my extreme range band indicator. You'll get my Fibonacci price target mapping course. These are all prices on my website. You'll get that 30-day trial membership to my trading club. We'll follow up Q&A, and then the option trading tutorial, another option course there. So you'll get all that today for $167. And just go, put in powercycletrading.com/special. Let me give you that link again, and then put in small cap Cal 15. Find this real quick for you. And then we'll go through any questions on any of that. Okay, so use this link here, powercycletrading.com/special. Click on that or copy and paste, and that's what you'll get there. Now, if you do want my alert services added to this course package 1, you can do course package 2. And with this, you'll get my 5 different trading alerts, depending on, I send out based on what the market's giving us. So you'll get these for over the next 4 months, plus 4 months of the trading club. And in either course package 1 or course package option 1 or option 2. And so the 5 different types of alerts depend on, what the market conditions are, what it's sending me as far as trade setups that I see. I could be sending out a butterfly or long condor trade setup. We did actually on Friday or Thursday, we did a long condor on Amazon, or it could be a calendar diagonal trade setup. Could be a butterfly, what we call pinning trades when we get into monthly expiration. Could be breakout reversals. These are credit spreads and debit spreads, or it could be selective earnings trades, which we did, one last Thursday we did on CSX, which turned out really good. So selective earnings trades during earnings season. So those are the 5 different types of trades that could be sent out. All right, so that's what you can look forward to there. Now, with this, you go to course package 2, and you've got 2 different options. You've got option 1 there, which includes the course extras that I showed you, which would be basically option 1 on course package 1. So today it's $597 with the discounts $507. If you want it with all the indicators and bonuses, it's just $30 extra, $537. All right, so these are the 5 different type of trade setups that I will send out over the next 4 months. If you want to start, you can, if you go on vacation, work or something, so you're not going to lose your time. And then when I send it out, you get a trading guide. I send you what option trade to use. A lot of members just do their own thing. They just want the trade set up. So if I send out a long, they'll just, go long calls or shares or whatever. I do a setup video review at the end of the day to kind of give you an idea why I was doing the trade, what to look forward to on the trade, what's my, outlook for it. Trades are listed and archived. Then for the next 4 months, you'll get access to our weekly Q&As, live and recorded. You'll get access every day during the week after the close, my video newsletter, access to my virtual trading room during the week for the next 4 months, and anything on my website, 50% discounts on all courses and software that I have on the website. So that's what you get off those different benefits there. I showed you the kind of alert trade summaries here, but this is just the alert service since starting January 1st, 2025 through yesterday. 140 trades closed out, 92 winners, 19 break even, 29 losers. Win break even rate 79%. Unaudited, just kind of summary idea of what you can expect for the alert service if you're needing some good help and some good trade setups there. And then just the overall summary since starting the first alert service I started sending out was back in May of 2018. Man, it's been a while. Through yesterday, 972 trades closed out, 690 of those winners, 74 of those break even, 208 are losers, run a 79% win rate, unaudited on those. Full disclosure on that. Okay, so that's kind of a summary there. And we just went through the different discount prices and just put that link in there, powercycletrading.com/special, and then make sure you put that promo code SMALLCAP, make sure it's SMALLCAP Cal 15, and then you're good to go on that. All right, and I'll make sure that everybody that signs up here today will get it on course package 1, you'll get it for $167. Yeah, sure, Kamal. Yeah, I'll get somebody to call you. Okay, hope that answers your question. Yeah, question is, are you doing a scan to find the stock trades? Yeah, I've got a couple different scans that I use. All right, so here was just, I was going to show you here. This was from Pam, one of my members. Really nice comment here. Just sending just quick note of thanks that you could maybe pass along to Larry for all the fabulous teaching he's done through the years. I truly enjoyed learning from him and the other traders in the trading room every day. I don't think there's a better trader in the world when it comes to option spreads and other ways to do trades than Larry. So I really appreciate that. That really was nice from Pam. Now the course that we'll start into next Saturday, we'll start out with part 1, the option selling kind of foundation. So we'll go through, I like to always start with the Greeks that really kind of are important to the different strategies that we're going to cover. So you have an understanding of those, so basically how time value works, trade probabilities, more on that, more on using standard deviation for your price targeting, and then option pricing, how that works, and we'll go through the trading rules and the timing, duration, time frame rules that I use there. And then part two, we'll go through first, kind of start with the basics of the income calendar spread, which then leads us into the income calendar diagonal. So we'll go through the basics of this spread, what those are, how it works, the benefits of the income calendar, the characteristics. So you've got basically what I call the trading edge, which is time and data. We'll go through that, how that works, what that looks like, risk review kind of section on that, trade setup steps, what those are, how to set the trades up. And then from there, we roll into this whole thing progresses into the calendar diagonal spread. All right, so that is the biggie that we like to really roll into. So we'll get into the basics of the calendar diagonal spreads, how that's a component of that calendar spread, but kind of morphs into the directional trade with a diagonal. So what are the benefits of the diagonal calendar, characteristics of it? The trading edge here, we have basically two. We've got that trading edge, time and data, but the other big trading edge is direction because of the diagonal part of the spread. So we'll go through the trade setup steps, trade adjustments. This is a big part. This is where you want to really learn what to look for to adjust these trades, reduce risk. In certain situations, we're able to reduce our risk all the way down to zero, like those examples on Chevron and Walmart. Resource part section, and then trading library, so you can go back and look at a lot of different trades. So that's a kind of overview there, and then everybody will get then basically bonus one will be my cycle reversal indicator. So this will be part of the course package. I've got this for Thinkorswim, TradeStation, and TradingView. So this is a really great tool that we use kind of based on momentum. There's an upper and lower study. So we get a cycle reversal up, the signals here are cycle reversal down. You'll get an arrow pops up, for up cycle, down cycle. So there's an upper and lower study to this. The indicator has that upper lower study. The lower study then shows also a couple things: overbought, oversold conditions plus the cycle reversal. The upper study then gives you a cycle reversal signal with a down arrow or up arrow for the cycle low reversal or high reversal. So it can be used across any time frame, used for swing trades, long-term trades, day trades. We use these also for if you do spread trades or pairs trades. Okay, so these are one indicator that you'll get, okay? And that will be currently for both packages here today, or both options, because the price for option 2 was not working. So you'll get this, you do, let's say, put it this way, if you do course package 1 for 167, you'll get the indicator. And then you'll get this indicator 2, bonus special 2, you'll get my extreme range band indicator, which is another one that we'll be using in the course. So this is identifies price extremes when price is too extended from its mean. So we're looking for a kind of buying exhaustion or selling exhaustion and a kind of a mean reversion. So this is a first signal that's that a security is starting to reverse. So a really good indicator tool for that. Very accurate signaling in advance potential swing trades, long-term market reversals using these extreme range bands. So you'll get that. I have it for Thinkorswim, TradeStation, eSignal, NinjaTrader. All right, so you'll get that indicator as a kind of additional bonus. So you can see the ranges, extreme range bands here. That white is like with extreme 3 ATR up or down. So this is a really great tool that we use. So you can see, just for example, here was a QQQ, got up here to that extreme range there, had a cycle reversal. So you get these two tools, down she goes. Here's one to the upside, had a really big pullback here, cycle reversal here, got to move back up. So that's one to use there. Now this would have been a perfect place for call calendar diagonal. Here would be a perfect place for a put calendar diagonal. All right, so that's why we use these tools. It can help us to get in with a good entry, good edge on entries based on timing. The other indicator or tool or, that you're going to get is my price target mapping course, which is based off of Fibonacci, but it's also based on 5 different things I look at. So this takes you through my kind of on-demand step-by-step Fibonacci course. I call it price target mapping because we use it to map out price targets for profit take or defense triggers up or down for our swing trades or day trades. So it's based on using Fibonacci price target analysis, automated trend lines or moving averages, price action support resistance, standard deviation, and unusual option activity. All this goes into it. The course explains how all this aligns together and how to use it. So it's a 3-hour plus course with the PowerPoint guide, 139 pages there. You'll get that. And then you'll get bonus 4s, my 30-day trial membership to my trading club. If you do the alert service part, that'll be 4 months. Okay, so this though, if you do, course package 1, you'll get this 30-day trial membership. You can start this whenever you want. So this gives you access to my virtual trading room during the week, 9:30 to 10:30 Eastern. We do this starting Wednesday through Friday. Then we start out actually the week with our live Q&A on every Tuesday, live and recorded. And then, on Wednesday, we'll start back into the trade room. Then you'll also get my daily video newsletter. So I go through the videos with a video with the market, did that day, what we're looking at, trades we're looking at, trades that we have on, kind of overview of that. Our trades then that we sent out are archived that you can go back and look at. There's a trader's educational vault that comes with this, some good educational material, and then a discount code that you'll get 50% off of anything on my website, trading software or, courses. And I always like to point out, one of my members, Jay, said, reading books is fine, but seeing the actual option trade setup really makes a huge difference. So that's what I try to, put out in the trade room or coaching room. If you have any questions on any of your trades or want to, help on a trade, I'm there to help you, to give you advice, based on what I've seen, my experience and knowledge. And let me make sure, make small gains on vertical credit spreads and then lose all the small gains. Exactly. That's one thing with credit spreads Kumar was talking about. Any way to mitigate the risk on credit spreads, too risky in general. Yeah, with credit spreads, the thing that I like to do is combine the credit spreads where, you're not just doing a pure credit spread. You're going to end up combining the credit spread with a debit spread. So to make a vertical, could end up being a vertical debit spread, or then you may end up, adding another credit spread to it, making a ratio, a vertical debit spread ratio or ladder trade. There are just a lot of things, but what I try to always do is not just do purely the credit spread. I want to add a debit spread to the vertical credit spread. So let's say you started out, let's say you had a vertical credit spread on, so you're short a call, long a call here, and then let's say the market pulls back a little bit, and you want to hedge out that risk a little bit, so you could add a long call debit spread. So now you're long a condor. So what I like to do is create vertical spreads where I can then adjust into either butterfly or a condors. Okay, so I'm not just strictly with just a credit spread. It could be you've got a bull put credit spread on and you want to reduce that risk. So what we could do with this, we're short a put, long a put, and then we could add another side to the trade. We could add a put debit spread. So I like to add the verticals to offset the vertical credit spread, adding the vertical debit spreads and things like that. So that's kind of a short explanation for you. Hopefully, maybe that makes some sense to you. All right, so then here 5, we'll do a follow-up Q&A, and that'll be on Tuesday, the day after our part 2. Okay, so we'll do that dedicated to the course, and it'll be live plus recorded. And then also remember, you get the 30-day trial membership to the trading club, so you can come into the trading room. Option bonus 6, you'll get my option trading tutorial. So this is a really nice little option course, 60-page option guide course with videos. And this is more covering just the specific Greeks, you know, like your delta, gamma, theta, just a nice thing to add to your trading library for options, option pricing, market maker secrets, more standard deviation, option delta, and probability. So really nice option course to complement the course we'll be doing next weekend. And then here's just a look at the Elite Open and Close Alert Service if you want to get into package 2. So I highly recommend the alert service. And this was one of the my members sent me this. This was Waleed, who actually lives in Kuwait. He says, Larry, I have to mention one thing. I'm subscribed to a lot of services that send out alerts. Some are good, others are not that great. But one thing I would like people on this webinar to know is when I get a trade alert from Larry, I do it blindly as time has shown me. This man is dead accurate in his recommendations, Waleed. And then just another nice compliment here. He said, Dan says, you're very diligent and totally thorough with your analysis. That is the foundation of the success of your alerts. I paid for my subscription with the first 4 trades I took with you. I try to really lay out the alerts, you know, so you can follow like Dan did and do the trades and learn. I was learning how to trade options as I went. Please feel free to share this with other participants. So a nice, you know, feedback there. And then if you do want to add the Elite Open and Close alert service, there are 2 options here. So option 1 would be you get the extras, and that's $597, but for today it's $507. Okay, and then if you do want it with the indicators and the bonuses, you know, all the bonuses today, it's going to be $537. So $507 just plus an additional $30, and there's a 2-pay if you'd like that. So I have there are 5 different alerts that may be sent out depending on what the market conditions are, what we're seeing in the market, what I'm seeing. So it could be a selective counter diagonal trade. It could be a butterfly or long condor. We just, like I said, did one on Amazon there. Could be a butterfly or pin trades that we do with butterflies and calendars. Could be breakout reversals, which are typically going to be debit or credit spreads, or selective earnings trades. So there are 5 different types that I can send out. When I do send it out, you'll get a trading guide. Like I said earlier, a lot of members just want the trades and they just do their own thing. Then I do a trade setup video review after that day, you know, after I sent out the trade, just to give you a little bit more information why I did it and what we're looking for. Then you get the access to the weekly Q&As live and recorded for the next 4 months, daily video newsletter for the next 4 months, access to virtual trading room the next 4 months, and those discounts. And you can stop and start the alert service when you want, so you're not losing your time if you go, you know, on a vacation or a holiday or something like that. Again, so, you know, when I do send out, I will send out a trading guide, so a suggested option trade that will give you the entry levels, profit targets I'm looking for based on unusual option activity, and our Fibonacci price target mapping is basically what I use. What option series to use, stop loss levels and guidelines, and I'm constantly updating. And then if we do adjustments, I'm constantly sending out adjustments for, you know, reducing risk, reducing trade costs, things like that. So just a lot of things that I'm doing, you know, to help you manage your trade. So, for example, here was, you know, like I said, I use this Telegram service, which is a free app. And, you know, here's like CVX. I sent this out. Here was CSX. Here was the double calendar spread that we converted to a debit spread. Here was the Amazon trade. This was an Amazon call Condor that we did on Thursday. Sent this one out on Friday. You can see here it says Amazon long trade around now 240. If long, the 30 Jan. 235.37F called debit spread, and short the 245.47 called debit spread, long multiple contracts. On this move higher, look to lock in some profit, 25, 35 bucks per spread, things like that. So constantly sending out these alerts for you to kind of keep you updated. And then if I see a nice adjustment to reduce costs, reduce risk, reduce debit, reduce theta, I'll send those out. So a lot of stuff I'm sending out on these trades for you. I do, like I said, a trade setup video review after the close, so you know why and what I was looking for on the trade. And I do the video newsletter every day after the market closes. Weekly Q&A, you'll have access to that live and recorded for the next 4 months in the trading room. All right, and 50% discounts on anything on my website. So if you go to the website, you know, anything you see on the site, then you can use your members code, and it'll give you a 50% discount. So if you go here, look at any courses, past courses, just go to trading courses, and any of the past courses, if you see something you want, then you just put in, you know, the members code, and it'll knock 50% off. All right, so that's, you know, all the different trading courses I've got, which are a lot. Okay, or it may be that you want some more software. You know, you can get my custom indicators, my scanners, you know, all of these tools. Now with this course, you're going to be getting these two indicators as part of the course. The cycle reversal indicator, you'll be getting this one. And again, this one, you know, is a bonus. So, but this one is $197, you'll get that. And you're going to get my extreme range band indicators. Okay, so those are just going to come with the course. So you'll get all that. And then let's go through the alert service. So I kind of went through the summary of the calendars earlier, just a minute ago. I showed you this one. This was on Chevron. This one we just actually completed. This was a beautiful trade, up over $700 on zero risk, adjusted to. Here's one we did on OON. This was a calendar diagonal that we set up on the 5th, took it off on the 9th. And, you know, I won't go through the details here, but these are very detailed, kind of describing the trade setup, going in, just kind of a brief view here. Here it says new OON long trading at 58.70, daily volatility squeeze, daily cycle low reversal, et cetera, et cetera. Target areas. So this was doing a diagonal, which is a counter diagonal, and this was buying the 23 Jan, selling the 19 Jan, 58.61. We did some adjustments, and then ended up here and took that off. And so here's the OON trade, just kind of quick overview here on that one. So set this trade up there, right there. Here are my indicators cycle. This was a pretty decent little entry. It had a really nice pop to the upside. You can see it had been going sideways here. See this volatility squeeze had been moving up. We had the cycle 1 and 2 positive momentum. This is an upside momentum cross that I like to look at. And so we got in right here and then ended up just getting out there. It started to stall out. So these are things I'm constantly watching and monitoring the trade for you. So we did this trade initially right here. Here was the trade setup. On this one, we went in and we bought the 23 Jan 59 call, sold against the 16 Jan 65 for $2.10 or $210. And so ended up out of this one pretty fast. This one started to stall out, so went in and got out on the 9th, and it was trading at 62.58, but it had a pretty decent move up from 58.70 to there. So that spread blew up to $371. We had a cost of $210. It was up $161, or 76% return on that. So that was OON. And here's a look at the butterflies. Here's one examples of our alert summary here. We've had since starting this back in 2019 through Friday, 243 trades closed out, 172 winners, 22 break even, 49 losers. Win break even rate run nice, 80% right there. Actually, I think, yeah, we dropped down. Actually, this should be 79. But anyway, these have really big potential, 2 to 1 up, sometimes even 20 to 25 to 1. All right, so these are just really high potential trades as far as profit, and very low risk trades. The average loss might be $75 on average. I mean, super low risk type trade setups. Here's a one that we'd done not too long back. This was on Amazon. And this was doing a butterfly. Like I said, I'll show you if I have time. I'll show you the condor we just set up on Amazon on Thursday on alerts. But here was the, I call this aggressive long. And so it was traded at 229.70. So what we ended up doing here was a butterfly. So we did the 230, 35, 40 butterfly, sent out that to do it around $1.25. Here it was on the 28th going out. I said, just updated here, said here for all those that hold, currently trading around, currently up around $197 per spread or 162% return on that. So that was the Amazon butterfly. So got in here, and on the 28th, it was trading at 233.11. So the butterfly setup was, this was sent out at 230.35, 235, 240. Total risk in the trade was $121, $5 wide spread, less the cost. Potential 239 or 313% return if it hit the top of the tent there. And this one went out right here, right there at 233.11. So the spread went from 121 to 318, so up $197, 162% return on that. Now these are really fun. These are very selective, but here are a couple to show you that these are what we call pinning trades. Here's one we did not too long ago. This was on GLD, and we set this up on the 12th. On the 3rd of December, it's trading 387.90. And we were looking for this trade for move potentially for a pin up to 400. And we got pretty close. So it says new long GLD long binary call butterfly. Anyway, this is there's a good probability that based on some high open interest for a potential move into expiration to the 400 strikes. So sent this out, do the butterfly here, the 400, the 396, 400, 404 at around $25. Okay, so did that. And then on the 19th, it was trading here at 399. Sent out an update, make sure you don't miss this. It was currently up $375 per spread, over a 1,500% return on that. All right, so these are pretty cool. And so this was the butterfly trade here. Got in right there, and this thing just grinded right into our target of 400. So had this trade set up was what was sent out, 396, 400, 400, 404, 25 bucks, 25 cents, $25, $4 wide, potential 375. If it hits the pin right there at the top of the tent, 1,500% return. We got pretty close on this one, and it went out here right at 399.74. That's pretty close, I'd say. And so this one went from, 25 bucks to 331 that last day, up 306. That's a 1,224% return on that. These are, like I said, very selective. Here's another one we did SPY, a put butterfly, and here was we were looking for a downside move. We call a potential pin to 560. So we did a 560, 560, 55 put butterfly. I said to do that around 40 bucks. And then this also got very, very close. This was up $232, going out 595% return on this put butterfly. So set up there, was pretty close to our target down here. And so this was that put butterfly here, 565, 60, 55, $39 of risk, $5 wide spread, less your cost, potential 461, that'd be over 1,100% return. And this one went out right here at 560, so pretty close. Nice little trade set up. Went from 39 bucks, blew out to 456. So this was up $417 per spread on that cost of 39. So this was up over 1,000% return in 4 days. Again, these are very selective, on these trades, not sending these things out all the time, but when we see a good one, these are pretty interesting. And here's just one last one to show you. These are very selective earnings trades that are sent out during earnings season. And we've had, since starting this back in 2019, 150 trades closed out, 110 winners, 17 break even, 23 losers. Win break even rate of 85%. Again, unaudited on those result summaries there. And here's one that we just did on Thursday of last week. This turned out pretty cool. So set this one up, did this as what we call a double calendar. And won't go, it's quite a bit of detail there, but set this up for like $30 of risk. I'll show you here in a minute. And then what we did on this one, we legged out and adjusted it to a call debit spread and ended up making a really nice return on this just the next day, just one day later. So this was on CSX. So these are selected trades that come out. So got into the trade on Thursday and adjusted it yesterday and took some profit here, had a really nice profit take there. We'll see where it goes. We still have a little bit on there. So started this thing out as what we call a double calendar, but you can see the risk on this trade was super low. We had $15 total risk on the call calendar side and 15 on the put side. So going into this trade, we had a total risk of just $30 per spread. And then what we did, this thing started moving up yesterday. So adjusted this into a call debit spread, closed out the put side and got out of the short call side and ended up with a long call and then sold against it an upside call, and created a dollar wide call debit spread for just $15. All right, so I had a $15 call debit spread, and this thing was 37.48. We had that spread up. It moved out to $45. We had a quick $30 profit per spread. That's a 200% return. So doesn't seem like a huge deal, but pretty nice return on capital at risk. So these are very selective there. All right. So anyway, that pretty much is kind of everything you'll get. I hope this was of interest to you, and you learned a lot here today. And I look forward to seeing a bunch of you hopefully next week and next Saturday at the workshop. So make sure to join us. And again, today you're going to get all this for $167. Okay. So you're going to get basically the price that I showed you of course option package. Option 2 is $197, but the price on the payment link's not working, so you're going to get it for $167. So I will make a note to my assistant to make sure that anybody that signed up. So if you do go in here, course option 1 or option 2, we'll make sure that you're 167 and you get everything here. Okay. And then on course package 2, we've got the 2 options. If you do course package 2, option 1, that gives you the live course, recorded course, and those extras. And you'll get it today for $507 to pay. And if you want all the indicators, bonuses, just for $30 more, it's $537. So, peanuts, right? $30, $30, and that's it. And I'll see everybody next Saturday on the 31st, 11 a.m. to 2 p.m. Eastern. And look forward to seeing you there. All right. Well, I appreciate everybody taking the time to be with me. Stay warm, stay safe, and we'll all get through this big winter storm here in a day or so. Thanks, everybody. Have a great rest of your day. Ciao.